All right. Let's get right into it. Okay, so after last video, we now know general market structure, trends, highs and lows. Now, let me just review general market structure, as I know I gave a pretty poor example last time. Um, yeah, let me go to just an uptrend because the one I gave last time was pretty bad. Let's let's get a pretty obvious trend now. Um, it's more like the 15-minute. Okay, an easy way to spot these trends is to use, instead of candles here, you can use a line. Now this makes it really obvious. We can see we're trending upward, trending downwards, trending back up, down, lower high, lower low, high, chopping around, down. This makes it easier to spot uptrends in the market. Yeah, like right here, we're going higher. We have a low, higher low, higher high, higher low, higher high, higher high, higher low, higher high, higher low, higher high. And if we change this back to candles, we can see exactly that's what it is. We have a low here, followed by a high, followed by a higher high, followed by another higher high, followed by a higher low, higher high, higher low. And you get it. Okay, so that's the trend. And now we can get back to what this video is going to be about. And this video is going to be about liquidity. Now, what is liquidity, you may ask, and why is it important? So, liquidity is pretty important as normally you want to trade after there's a sweep of some type of liquidity, whether that be external range liquidity, internal range liquidity. Now, I'll go over both of these in this video, and you're going to see how important this truly is in the markets and how easy it is to spot this. So, I'll just start by saying, what is liquidity? So we have liquidity, and this can have very different names, and I'll just type them out. We can, oh shoot, let's clear that. We can have something called buy stops, buy stops, sell stops, sell side liquidity, buy side liquidity, internal range liquidity, liquidity. So now these are the most common terms you'll see for what liquidity is, and I'll briefly touch on all of them. Um, Starting off with buy stops. So a buy stop is a type of order that is going to be placed by retail traders. Now, these orders are mainly placed at highs and lows within the market, and when a buy stop is hit, where most retail traders are trading, we're going to see a lot of movement at a price due to the fact that a lot of orders were just executed within the market. Now, think about it like this. A stop loss, which is used to exit someone out of a trade, let's say a stop loss is placed at this high. Um, if it's placed here and we sweep it, and by sweeping, I mean price coming up and taking out that level. So let's say we put in this high here, instead of just going down like that, we start trading up, trading up, trading up, and we take it out and we form another high. That is called a sweep of liquidity. And a lot of times, price will react to the sweep of liquidity. And that's just a common theme you'll see within the market. So uh, how does this go with buy stops, sell stops? So as I said before, buy stops and sell stops are types of limit orders. If you're gonna sell, Let's say you're going to sell right here. Okay. Let's say you're going to sell right here. This gray thing is going to be your stop loss. And if you're selling, you're going to be placing buy stops because you're going to want to buy back your position at that higher price to cancel out the position you already have. And it goes the opposite for sell stops. If you're buying, you're going to set a sell stop at a low or something because you're going to want to sell that position that you have bought to exit you out of the trade. So when you're selling, you're placing buy stops, and when you're buying, you're placing sell stops. Easy enough. And this is why it's called, this is why liquidity can often be referred to as like a stop hunt or a stop run, as it'll tend to seek out um, highs and lows, which is where retail traders have their stop losses. Okay, sell side liquidity. So we know buy stops are up here. So as I was saying, sell side liquidity is going to be just lows essentially, same as sell stops. Yeah. And what does that mean for buy side liquidity? It's going to be at these highs. Now, this is probably the most common name you'll see for types of liquidity being referenced. But yeah, essentially liquidity is just highs and lows in the market that are quite prominent. As we can see, let me find a decent example. Um, yeah, no. So yeah, as you can see, we have this high here. Boom. And label it like that. And what do we see? We see price makes this high, and then we trade up, we sweep it. As you can see, we only just wick it out. We don't even close above this. And then look at the reaction we get. We start selling off massively. That's just like an example of what can happen. Obviously, this isn't what happens every time, but a lot of times you'll see a major type of move occur after a liquidity is being swept. You'll see this here, some internal range liquidity gets swept down here by these wicks. Then what do? We continue to pump very high. Yeah, I mean, if you look throughout the market on your own, you will see that off these highs and lows, once price sweeps it out, there tends to be a lot of movement following that. I mean, you can even take this example. Like, we, this is called souping. It's where you like barely touch the level, go a little through it. We soup this level, and immediately we see rejections off this, and we see us buying and just reacting aggressively off this sweep of liquidity. And as I said before, time is fractal. Time is fractal. What does that mean? That means whatever happens on one time frame will happen on all time frames. Now that doesn't mean all liquidity is the same, and quite frankly, it's not. What you really want to see when you're planning to execute a trade is some type of high time frame liquidity. Now, what do I classify as high time frame liquidity? This will obviously be the 1 hour, let's start the daily, the 1 day, 4 hour, 1 hour, and 15 minute. Those are really where I want to see liquidity being swept. Those are your more external range liquidities. Those are just very prominent highs and lows in the market. And that is where we see the largest reactions. If we scale down to the 1 minute, we'll see that there's many, many highs and lows. And we'll see we get reactions, but it's just not as probable. Like we can even see right here, boom, we sweep this liquidity, and what do? We get a strong reaction down just off that sweep. Now there are definitely other factors at play here to why this happened, but you know, it happens on all time frames. You don't want to structure it around lower time frame liquidity runs. And shoot, I wanted to touch on something else. Um, oh yeah, I don't think I've gone over this. What is a swing high and swing low? It's basically just higher low like this. This would, for instance, would be a shoot. This would be a swing high. It's a high that's being formed within the range of an overall leg. Like this is a swing high. This is a swing high. This is a swing high. Sorry, let me circle. This is a swing high. This is a swing high. I wouldn't. This is like a prominent low. This is a swing low. Another swing low. You see, like it's very obvious. But yeah. So a swing high is just a higher low that's formed within the range, within like an overall range. If we go to the 1 hour, we can see, yeah, like this is also a swing high within this range. This would be the prominent low. I guess this would be considered somewhat of a swing low. This wouldn't be a swing. This would be just like if you're gonna take a range, you're gonna take a range from this high to low. Think about it like that. Like where is your range defined by? Everything else inside that is a high or low is considered a swing high or low. And swing highs and lows are very good internal range liquidity, and you will normally see a reaction off that. But once you sweep external range liquidity, such as a prominent high or low that is not within the range, you will see drastic reactions in price. And that doesn't always mean that like we're gonna let me change that we're gonna sweep, let's say price runs up there, we sweep is high. That doesn't mean price is just gonna come tumbling down. Like don't expect that. Price can sweep, come back lower, and then using something that we'll learn later, like a fair value gap or something, it goes and shoots price even higher. There are many things that can happen. Don't expect a pattern to always play out. You don't want to really trade based on patterns. You want to recognize them, but you want to use your intuition and react off what the market is giving you. So, liquidity, what is it? Just as a recap, it is a higher low where retail traders will place their stop losses, and this generates volatile. I'd say this gives more volatility to the market as more orders are being executed, and therefore it just adds volume and volatility. Because when we have more orders being executed, we have more orders being traded, and that is normally why we see a lot of movement off these levels being swept. And also, banks and institutions need a lot of liquidity in order to place their humongous trades. So, for instance, if we know that there are a lot of orders placed at this higher low, and a large bank or institution needs to place an order worth billions or hundreds of millions worth of dollars, well, it's going to move price significantly. So it needs that liquidity in order to execute their order. And that will that will tend to move the market, and that's why you will tend to see large reactions off these highs and lows being swept. Obviously not instantly, but more often than not, you will see a reaction once there is some form of liquidity being swept. I mean, another example, like right here, like we have this 4 hour low, we have this low barely, just barely sweep it out with this wick, and what reaction we get? We get a huge reaction to the upside. Like this is very common within the marketplace. Like even this high being swept out, it gets souped, and we get huge displacement like lower. Like very common. You can literally create a model just off this fundamental principle, and understanding this principle will make your life so much easier. So yeah, that's just liquidity in a nutshell. And yep, I'll be back later.